For 2025 full-year GDP, U.S. grew at 2.2%. 2024 was 2.8%. The slight drop was because of quarter four's consumer spending and exports pulled back. And there's some impact from the government closure, which happened on 1st October to 12th November. But however, looking at another key Fed metric, the final sales to private domestic purchasers increased at 2.4%. It's still indicating a solid underlying demand in the U.S. economy. Inflation is still firm in December. The core PCE, Fed's preferred, was at 3%. This is still high above the 2% target. Headline PCE is just a shy under 3% at 2.9%. Looking at the probability of rate cut, let's ignore the 40-50% ones. A meaningful figure is 70% probability, which will likely be on 29th July's Fed meeting. Broadly speaking, the topic of U.S. interest rate will tie into this section regarding cost of business, which also covers Capex. Some background. 2026 pretty much begun the same way as last year end. Investors' confidences are relatively high. You see the pickup in prices here at the S&P chart on the right. However, with the strong narratives and data pointing to the U.S. economy being decent, the bull market hasn't followed. So, decent news isn't translating into further index gains. Markets typically rise when results beat whatever investors priced in. The forecast and estimates. Furthermore, recent data have been supportive. Indicators are well. Manufacturing data is better than expected. The mid-February jobs report also show resilience. GDP, okay, full year at 2.2%. And many companies delivered quarter four earnings that are optimistic. The reason why market isn't breaking higher is simply this. Investors increasingly want evidence to show that today's massive AI spendings will translate to attractive returns. In simpler terms, they want clearer proof of returns. On the right, these four big tech-related companies are spending and have forecasted billions in Capex. Capex, like working capital, affects a company's cash flow and hence its valuation. So when you look at price and valuation, if valuation drops but price is still high for the time being, then that stock will not look attractive if that scenario drags on. The uncertainty in investors is translating to a rotation in the market. Towards the end of 2025 and beginning of this year, tech has been a laggard, especially when you look at the S&P 500 equal weighted index at the right. That's basically the same 500 companies, but each company is allocated with a fixed weight of 0.2% of the total index. The individual company's market cap is irrelevant. This equal weight index is at the price of over 8,000 versus the high 6,000 to low 7,000 when you compare with the traditional market cap weighted index. What this means is gains are coming from more average stocks because investors now they favor cheaper and cash flow oriented companies. And investors seem to be using big tech stocks as a source of funds to buy the smaller cap, cyclical companies, and commodities. In simpler terms, profit-taking exit from big tech and enter the smaller pockets of such companies and commodities. Gold, silver, copper. But for the longer term, whenever smaller cap and lower quality stocks, which typically are more volatile, disappoint either revenue growth or earnings, very often the money will shift back towards quality and financially strong companies. Those with solid profits, steady earnings, and healthier balance sheet. Well-managed debt in the capital structure. Looking at Morningstar's top 10 blue chips, picks at the list at the right, these are companies that are typically financially strong. Now, rotation is happening for the time being. But when sentiments change, when the lower quality and more volatile stocks start to disappoint, you'll likely see a rotation to financially strong companies. Over the weekends, the Supreme Court struck down Trump's tariffs agenda related to the IEEPA. Currently, the law says that the president doesn't have the authority to impose such tariffs, and Trump must point to clear Congress authorization, which he cannot. Until date, at the picture at the right, it's estimated that U.S. tariffs totaled about $175 billion, and it's unclear whether this amount needs to be refunded to the respective companies that paid. The Federal Trade Court and Federal Appeals Court both found Trump's IEEPA tariffs illegal. Many of Trump's tariffs were enforced by the International Emergency Economic Powers Act, which generated a lot of U.S. tariffs revenue last year. However, IEEPA does not explicitly mention tariffs. It only allows President to regulate importation of foreign property transactions to deal with extraordinary threats. In response, Trump reacted. He first said that he'll enforce 10% global tariffs, and a few hours later, he increased it to 15%. This 15% will replace the IEEPA duties and is supported by Section 122 tariffs, which will take effect immediately and on top of existing levies, and it'll last 150 days. And in the upcoming days, Trump will share more details. But when you weigh the differences, this 15% doesn't really make a difference compared to the existing rates. On to UK Euro area's second biggest economy. Inflation dropped. December was 3.4. Look at the chart, and at the right, it dropped to 3%, mainly because of a drop in petrol prices and food prices. So Bank of England will continue to monitor this, and only when they are more certain that inflation will trend towards their 2% target by April. Then they will mention about rate cuts. Jobs data showed a further sign of weakness in labor market. Unemployment rate is at 5.2%. It's the highest level since 5 years. So when you tie inflation and the weakness in labor market together, well, cooling inflation and weakness in labor market together, right? It spells with cut, soon. Economists are expecting BOE to cut interest rates sometime in March or Q2. And one more thing, growth in UK at the full year number is a 1% figure. But Q4 last year versus Q4 in 2024 only grew a 0.1%. So again, all of these adds up to a potential interest rate cut soon. Japan has good news. Its inflation fell to 1.5%. It's the lowest since 4 years ago. If you look at the bar chart at the right, inflation was above 2% for 45 straight months until the latest one. The declines were driven by drop in food prices and petroleum products. And the new Prime Minister, Sanai Takaichi, pledged to suspend the 8% food tax for 2 years. Japan's full-year GDP growth for last year came in 0.1%, but they almost fell into technical recession. Bank of Japan say that there will be more cycles of rising prices and wages, and the government's economic measures will be supportive. However, all of these will unlikely delay interest rate hikes. Japan is opposite from the rest. The BOJ is expected to increase interest rate in June this year, simply because they only recently escaped deflation. To maintain a healthy amount of inflation, the interest rates cannot be too low. When interest rates are too low, it's easier for businesses to get capital. Conversely, when capital is more expensive, companies will typically raise prices of their products and services, hence flowing into the overall inflation rate. And when economy falls into deflation, consumers will keep delaying their commitment to purchasing big-ticket items. That will hurt corporate profits.